Welcome to the Utah Retirement System's webinar series. While this webinar has been pre-recorded, the information is still relevant. Please see the description below for links to the different sections within the video and other helpful information. We hope you find this webinar to be a useful resource in your retirement planning.
Welcome to the Finding Your Perfect Recipe for Investing webinar today. As we go through this webinar today, we'll be looking at some different retirement options that URS provides and discuss what might work best for you given your particular circumstances. So hopefully it'll be helpful for you today. So as we go through this, I just wanted to kind of point out that different returns on your investments can make a huge difference in your savings plan balances when you retire. Here we have a chart that shows the outcomes of 3 different individuals that have had different returns in their investments through their 401k. Each started with a salary of $40,000 and received 2% raises each year, and they each contributed 10% to their salary to their 401k. So all of them had basically contributed the same amount. The only difference is how well they invested their money. And so investments can really make a big difference in what happens throughout your career and what you're going to end up with in retirement. As you can see, the person shown in red received a 4% return on their investments throughout their career. They ended up with just over $400,000 in their 401k when they retired. The person shown in blue received just 6% return on their investments throughout their career. And as such, they received about $600,000 in their 401k. The person highlighted in green received an 8% return on the investments. Probably the one that we all want to be, right? And being able to maximize our returns on our investments. But this individual ended up with just over $940,000 in their 401k when they retired. So each may have taken different risks in their investments. One may have been a little more conservative, or one may have been a little more well diversified. One may have been a little too aggressive, or been just the right amount of had just the right amount of aggressiveness. But really what it comes down to is all the facts are determined by our outcomes. And today, as we go through this webinar, I hope to talk a little bit about some of the different types of investments, some strategies that can help you in your investing, and just some things to watch for. So in the retirement savings world, we often use our 401ks, our 457 plans, our IRAs, maybe it's a traditional IRA or a Roth IRA, as vehicles to invest our money. And when we use these savings plans, we typically invest in what's called a mutual fund to increase the value of our savings. You can liken a mutual fund to a pie or a cake just because it has many different ingredients that help you invest your money, and they're all baked into one fund. A mutual fund is, the definition is actually a type of financial vehicle that's made up of a pool of money collected from many different investors to invest in securities such as stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers, and they allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. And as an investor in your 401k and in these mutual funds, you are those investors. That mutual funds portfolio is structured and maintained to match certain investment objectives. And so they each have basically a different recipe. And depending on the ingredients in that mutual fund, the investments you are invested in might look a little different. Each mutual fund and its individual ingredients, those stocks, bonds, and other assets, will provide you with a different flavor. So you might have some stocks. Those stocks are an investment that represents a share or partial ownership of a company. You might have some bonds in some of these mutual funds. A bond is a fixed income instrument that represents a loan made by an investor to a borrower. So typically those borrowers are companies, corporations, or governments. Then you also have real assets such as commodities like gold or silver or grain, or there's a whole host of different commodities. Or maybe it's just real estate, some type of a real estate asset. So depending on the makeup of the mutual fund that you're invested in, you might have different flavors of your mutual fund pie or cake. And at URS, we actually have several different mutual fund options that are available to you. And I just wanted to kind of go through those with you to kind of help you understand those. At URS, we have 8 different core investment options, and each have a varying degree of risk and a variety of different ingredients. You can see that over the last 10 years, just shown here in the graphs, that each have had different investment results. You see some of those that are pretty flat, like our income fund. You have some that have gone way high. They've had some really good growth years and some really bad loss years, like our international fund. So there's a variety of differences in each of those funds. I wanted to just kind of highlight a couple of these funds for you, just so you can kind of get an idea what makes up the ingredients, so to say, of each of these investment options. So for example, the income fund, this is a really stable value option and actually is our most conservative investment choice. This mutual fund contains financial agreements from creditworthy banks and insurance companies. They protect against changes in interest rates and smoothing returns. Some of the items included in this income fund are like book value contracts, they're government bonds, they're short-term investments. They actually act a lot like cash in a lot of ways. And you can see that this is very low risk. On our chart here, you can see they haven't lost money over the last 10 years. It's just been very stable and low risk. I think over the 15 years, they've made 2.71% over a 15-year period. So, or 73%, excuse me. So they're not making a ton of money, but it is a stable value and conservative fund. The balanced fund is a fund that actually is a little bit diversified. It's invested in approximately 60% stocks and 40% bonds. And this fund is actually considered less risky than most stock investments simply because it has that diversity. But it does have a higher risk than most fixed income investments like our income fund or our bond fund. This is considered somewhat of a moderate risk investment. And we'll talk a little bit about that fund here in a few minutes. The large cap stock growth fund refers to the cap in that refers to a company with market capitalization of more than $10 billion. And this emphasizes increases in value and seeks to identify companies with future relative earnings strength. So the portfolio really focuses on bigger businesses like Amazon, Alphabet, or Google. A lot of us know Alphabet as Google, Netflix, Microsoft, MasterCard. The portfolio is also actively managed, meaning that there's individuals that are actually going in and trading stocks regularly to react quickly to the changing fundamentals of these companies and the prevailing market forces. This is a higher risk investment, but over the past decade has really performed very well. As you can see, our large cap stock growth fund is over the last 10 years has made over 14%, 14.75% in the investments. The small cap stock fund is probably our highest risk fund. It invests in a broad cross section of U.S. small companies. That's the small cap that's referencing, whose size falls within the smallest 10% of companies listed on the New York Stock Exchange and NASDAQ National Market System. This includes companies like Deckers Outdoor Group, Cathay General Bancorp, Five Below, Green Dot Corp, and Marriott Vacations Worldwide. This is, like I said, one of the more risky funds, but has had some really great years. There's one year over the last 10 years in 2013 that it made almost 42% in the investments. And there's been some down years, as you can see. Last year was one of those where it lost 13.3%. So you can see that each mutual fund is made up of different ingredients that provide a little bit different flavor. Due to some of the funds having some increased volatility, you don't want to just have all your money invested in one type of investment. And that's why diversity really matters. You want different flavors included in your investment cake or pie. You might want to have like a piece of the small cap fund or the large cap growth fund, a piece of the bond fund, and a piece of the income fund to provide that stability in your investment portfolio. And you get to actually choose the different flavors of your pie. Here at URS, you can choose between those 8 core investment options, and there's some other options that I'll go over here in just a minute. You can choose how big that piece of the pie is that you want to take to diversify your investments however you like. For example, with a diversified strategy and good years, you can make money in your investments from the small cap fund. In the down market years, you can protect yourself from losing all your money by having some investments in the income fund or the bond fund. By having multiple slices of the pie, all from different types of market funds or market funds, you can diversify your investments to improve your long-term investment outcome. And so this is really important. Just to kind of give an example, if you were to just invest in one type of fund, you can see the outcome of many of these different types of funds over the last 10 years. And just so you're aware, over the last 10 years, we've really had probably the longest bull market run that we've ever had, meaning investments are growing. And so you can see some of our more risky investments like the large cap stock fund, the small cap stock fund. Those funds have performed very well. There haven't been a lot of down market years. So this can be a little bit deceiving. But if you look there, you want a good mixture of the different types of investments. And you can see the different asset classes within the core investment fund options that URS offers. The funds earned higher returns some years and experienced lower returns in other years. For example, if you look at the international fund, that's highlighted in that green there, that's made up of global stocks. And over the course of the past 10 years, they showed incredible growth in 2009, 29.6% growth. In 2012, where it earned 17% growth. In 2017, where it earned 27.6% growth. However, it also had some really low growth in other years. It lost 14% in 2011, lost about 3.9% in 2014. Last year, it lost 14.5%. So you can see the volatility that's included in the international fund. Ultimately, over the last 10 years, that average has been it's earned about 5.6%, just a little bit more than our bond fund. That's a little more stable. So if you remember, we talked briefly about the balanced fund. This balanced fund is a more diversified mutual fund made up of 60% stocks and 40% bonds. This fund doesn't look like it would be the fund to invest in because it never makes the most money, as you can see. It kind of stays in the middle. But it also never loses you the most money on your investments. If you look at the chart above here listed, the balanced fund is right in the middle just about every time. And ultimately, you can see that the fund generated 10.9% growth over the last 10 years, which is really actually pretty good when you're able to achieve that over a longer period of time. It's recommended really that you look at having an appropriate mix of investments to ensure you're going to have steady growth while minimizing potential losses in the market. And one of the things that I want to just really quickly ask before we move any further is I want you to really consider here, what is the most conservative option here that we offer at URS? What do you think that is? Okay, we got a few that are saying the income fund. Okay, one that's saying the balanced fund. Oh, and the bond fund is there. Okay, good, good. Yeah, so it is actually our income fund. If you look at our income fund, again, and I mentioned this earlier, um, it hasn't ever lost any money over the last 10 years. It's just remained really stable. Our bond fund is our second most conservative fund. It actually has earned over the last 10 years a 5.21%. But there have been a couple of years where it's just had some really minimal losses, 0.3% in 2015 and 0.04% last year. So it barely lost some. Our balance fund isn't as conservative. It's considered kind of a moderate risk investment, but it actually is a good balanced fund, diversified fund that you can utilize. So good job. I appreciate you taking the time to answer that question for me. So at URS, we actually also offer what's called a target date fund. And these URS target date funds serve the purpose of offering diverse ingredients that's made up of stocks, real assets, and bonds to allow for growth while attempting to minimize losses. So here we go talking about being able to make money, but also to minimize losses in our investments. At URS, we have 12 different target date funds, actually 13 if you count our target date non-vested fund for those that aren't vested yet with their 401k monies that's supplied by the employer. But these target date funds are based on specific years of when individuals might want to start withdrawing their funds from their account when they retire or when they need additional money. We often here at URS will default individuals into one of these funds if you don't choose an investment option, and it's typically based on the closest year to that individual's 65th birthday. So really what we look at is the longer you have until the target date. So let's say you're looking at the target date to retire is in 2040. The longer you have until that target date of 2040, the money will be more heavily invested in stocks, which are typically more risky investments. Let's say you are getting closer to retirement or that target date, let's say in 2020. Let's say you have a couple more years until you're ready to retire. The money is going to be more heavily invested in bonds, meaning the investments are less risky. So let's take a closer look at a couple of these target date funds. For example, in the target date 2045 fund, the fund is heavily invested in the stocks, such as the URS large cap stocks, the international fund, and the small cap stock funds that we just talked about in our core investment options. Basically what that means is 83% of the monies in the target date 2445 fund are invested in stock funds. 12% is invested in real estate, or the real assets, the real estate and commodities, and the other 5% is invested in the bonds. And you can see so you can see that that's going to be a little bit more risky of a little more aggressive in investments because you have time to make up for losses if necessary. And as you can see, the target date funds gradually adjust throughout your career and into retirement. The investment mix gradually and automatically shifts towards more conservative investments as you age and enter into retirement. So in another 25 years or so, the target date 2045 fund will look a lot like the target date 2020 fund. So if you look at someone that's closer to retirement, that's going to potentially retire next year or the year after, say that target date 2020 fund, they're more heavily invested in bonds. They're actually invested 51% in bonds. They're shifting away from stocks, which are 36% of the investments are in the stocks, and they have about 10% in commodities and real estate. So you can see how that diversity changes based on the age of the individual and when they're going to start withdrawing that money. How you invest your money is crucial to the overall performance of your investment accounts. It's important to make sure that you've diversified your investment portfolio properly to maximize your earnings while minimizing your losses. The longer you have until retirement, the more aggressively you can take that investment in a larger portion of your portfolio in stocks, because you have time to make up for those losses you might experience. And stocks will give your portfolio more potential for long-term growth. However, there may be more short-term volatility. You might have those losses, like I mentioned, with the investment fund or the international fund and the small cap fund, where you might lose a little bit. But if you have less time until retirement, consider investing in lower risk investments such as bonds. This approach helps you to really preserve your retirement savings that you've earned over your career. We know that everyone's situation is going to be different. Your current age, your life expectancy, your income, your retirement goals, and even your risk aversion or your risk profile will determine how you will invest your retirement savings. So consider how you're going to diversify your personal investment pie. Again, you may want different flavors included in your cake or pie based on how risk averse you might be. When you're looking at drawing down your funds, and also how long you have until you retire. By having multiple slices of pie, all from different types of those mutual funds that we're talking about, you can diversify your investments to improve your long-term outcome. You may want to consider a target date fund just simply for that purpose, because you have a built-in diversified pie already made for you. It's a pre-made diversified pie, much like the picture that you have on your screen here. A couple of other things that I want to just ask here. One of the big questions I think it's important to ask yourself is, how often do you think you need to make adjustments to your investment mix? And what do you think? Okay, so we've got several that are saying once a year, once every few years. Okay, good. Got a few different answers here. All right, so once a year or once every few years, yeah, really what it comes down to is, in the grand scheme of things, you want to kind of stay the course, right? You don't want to do it too often, once per month or whenever you think about it. I'm glad none of you said that. But you also do want to keep your eye on it. So you don't want to never look at that. I know that's a double negative, but you want to make sure you're paying attention to it. So once every few years is actually probably the better answer, but once a year is okay as well. Some things to really consider, and thank you for answering those questions. Some things to really consider here is, you need to give your pie or cake time to bake, right? Often the longer you have your investments in the market, the better they're going to turn out. Here is a screen of the Dow Jones Industrial Average over the last 41 years, or 31 years, excuse me. And it started out in 1987 with just over $2,100. The Dow Jones itself was 2,100 points at that time. It's grown over a period of that 31 years to nearly 10 times as much, that 26,000. Okay, so you can see how much it's gone. You've seen some of the downturns in the economy, some things that have affected the results of those, like the recession, oil prices tumbling. You know, we've had some some crazy things go on at the end of the year with some of the scares of the China trade tariffs and different things like that. Um, but overall, what it comes down to is that it's good, even through the ups and downs in the financial markets, to stay the course. Historically, many events have resulted in downturns in the economy, but those investors who stayed the course through those up and downs tend to do better in the long term. Just to give you an example here, we have a term that's used in the financial world called dollar cost averaging. And dollar cost averaging is a way that you, as an individual who's potentially investing money on a monthly basis by putting money in your 401k or your IRA or 457 plan, it's a way to get the most out of staying the course. Simply means you're investing that same dollar amount in a retirement account, pay period after pay period, regardless of how the financial markets are performing. So if you look at the chart here above, or right in front of you, excuse me, if you purchase $100 worth of shares every month at $5 per share, $5 per share, the investment never changes value, and you'd have 100 shares 5 months later, your account value would be $100. That's the red line there. So you're getting that $20. One of the nice things about an up and down market is that you can actually make money off of that. And if you look at the green here, this is what we call dollar cost averaging. Instead, you purchase $100 worth of shares and the investment fluctuates, as shown in green there. You end up with almost 108 shares worth $5 each after 5 months. The dollar cost averaging account is worth about $540, $40 more than if the investment stayed stable, and the account is worth an extra 8% merely because it purchased more shares in month 2, automatically through that payroll deduction when the investment was down in value or on sale. Even despite the cost going up in month 4, you still come out ahead. Investing is simply a race to collect shares. When an investment is on sale or the market is down, you buy more shares with a constant dollar amount invested, such as through your payroll deductions, going into your 401k. And when that investment or the market rebounds, your shares are worth more. More shares at a higher value means a larger retirement account. And what ultimately matters is how many shares you have and how much they've grown in value by the time you reach your retirement age. So that's really what it comes down to. One other thing that I want to ask here is just a quick question, because this kind of leads into our next topic that I want to kind of highlight. So the question is here, imagine you have a $10,000 investment earning 7% throughout your career. How much of an impact will a 1% fee incur on your savings? You think it's a few $100s, thousands of dollars, millions of dollars, or more than the federal deficit? Well, that's kind of a joking answer, but how many think it's a few $100s, thousands of dollars, millions of dollars? Okay. Good. We've got quite a few that are saying a few $100s, a few saying thousands of dollars. Okay. Good. Good. Oh, we've got a millions of dollars one. Awesome. Okay. Well, let me show you here. You guys did an excellent job. I love the answers. A few $100s, thousands of dollars, millions of dollars. Now, let me show you here what the answer is. When we look at fees are one thing that can, I think, cause your cake or pie to burn a little bit, if you want to use that analogy. Nearly all investments have some sort of fee attached to them, including here at URS. These fees can have a marked impact on how much you're going to have in your account at the end of your career. For example, If you were to save 7% of your income from ages 25 to 60, starting with a salary of $30,000 per year, 2% in raises, and based on 3% inflation, you'd end up with a present value of just about $400,000 in a savings account. That's with no fees. However, when fees are taken and compounded over time, you can see the impacts they have on the account. For example, for a reasonable fee of 0.5% or 50 basis points, as we use in the financial world, an individual would be left with $353,000. They'd be charged approximately $41,000 in fees over their career, over that 35 years. If you increase the fee to 1%, then this individual would have $317,000 left in their account, and they'd be charged $77,000 in fees. You increase it further to 1.5%, then the individual would end up with about $285,000 with $108,000 in fees that have been charged over their lifetime. So you can see the impact. It can be thousands of dollars. I just want to bring that over again here. That impact can be thousands of dollars. Fortunately, not millions. We're doing 7%, but it can have a marked impact on what you earn over your career. At URS, we do everything we can to keep our fees as low as possible, and on average, the URS fees are about 37 basis points, or 0.37%, which makes us really competitive with the market. In our world, we see fees range from our fee base, so that 0.37%, all the way upwards of 2% or even more sometimes. And this is something that you really need to watch, especially if you have investments outside of URS. Something just to consider in regards to that. At URS, you have many great recipes for your investment cakes and pies. We have the 8 core investment options like we mentioned earlier, and as you diversify these options, you can create your own special recipe, your own investment pie. You have several different target date fund options to choose from. These are basically pre-made pies that you can choose from that will automatically adjust for you as you get closer to retirement. The low annual fees is really helpful as part of that recipe too. The money you invest is yours to continue compounding and growing, and we do our best to minimize these fees for your benefit. And we also offer free individual retirement planning sessions, and I'll talk about this here in a little bit further, but this is where we can meet one-on-one with you to discuss how you can get the most out of your retirement benefits, including through your investment options. It's kind of like a one-on-one cooking class, if you will, where we can talk through and go through your investment recipe to help you achieve your retirement goals. And we have several other resources available on our website, such as publications, webinars, seminars, and other educational materials that can assist you with your investments as well. So I just wanted to really point you in a couple of different things on our website as we close out this webinar today. If you log into your account, go to the login screen there and log into your account and go to the education tab. One of the resources that we offer is what's called an investor profile questionnaire. You can take this investor profile questionnaire, answer a few questions, and we can help you find out what kind of investor you are, whether you're a moderate investor, an aggressive investor, a conservative investor, or somewhere in between all of those. And after taking the questionnaire, we'll then make an investment recommendation specific to your needs based on your age and this investor profile that you have made. As part of that recommendation, we'll tell you which target date fund you should participate in or may be recommended for you. It's an easy way to help you find your perfect recipe for investing. In addition, if you need to make adjustments to your own investments here at URS, if you just click on the fund that you'd like to change, the vehicle, the 401k, the 457, the Roth IRA, whatever you have open there, If you go on the left-hand side, you can see the change investments. If you go to the change investments link on the left-hand side, it's going to show you where you are currently invested. And if you'd like to make a change, you can just change that current or future allocations, or even both. It's going to select both automatically, default there, but if you just want future allocations, you can do that. And then you can select add investment options. Once you select that, it'll give you several different funds that are available to you, including our 8 core investment options and our target date funds. And you select the fund that you'd like to add. You just hit add selected. And then you can revise the allocation percentage on the right-hand side there and confirm the change. So instead of having the future allocation set for 100% in the target date 25 fund in this case, you can go to the target date 2035 and change that allocation to be 100% there. And then you have to confirm that again on a different screen. Again, I just want to mention to you, if you do want to talk through the different options available to you, we'd be happy to sit down and meet with you. We'd be happy to answer any questions. Our retirement planning advisors are very well versed in our investment options and how they've all performed and what might be a best option for you as well in helping you create your perfect recipe for your investments. To schedule one of those sessions, you just go to the education tab there. On the education tab on the left-hand side, you have the individual retirement planning sessions, and up will pop up all the dates, times, and locations that we have available for you to sit down with one of our retirement planning advisors, and you can schedule a meeting that way. So with that, I just want to make sure that you are aware of that we do have the URS savings plans are not insured. They're not guaranteed by URS or any government agency, but just so you're aware of that, this is an important decision for you, and so you need to be aware of what